SAIC Motor, once China's largest car maker, has reported a shocking drop in profits, with net profit plummeting by 93.5%. The company's latest financial report paints a grim picture. In the third quarter, SAIC's revenue reached 142.6 billion yuan, marking a year-on-year decline of 25.6%. Net profit came in at just 280 million yuan, down 93.5% from the same time last year. For the first 3 quarters, the company earned 419.6 billion yuan in revenue, a 17% drop, while net profit decreased by 39% to 6.9 billion yuan. SAIC attributed this sharp drop to several factors. The company says a shrinking fuel vehicle market, intense price wars, reduced sales revenue, lower profit margins, and weaker cash inflows all contributed to this decline. One well-known blogger, known online as Wuhan Three-Legged Crow, expressed sympathy for SAIC's struggles. The company faces internal and external pressures, from high tariffs up to 35.3% imposed by the European Union to losing market share to domestic brands and disappointing growth in its new energy sector. Despite these challenges, SAIC is standing firm and preparing to face the EU in court. SAIC's third quarter net profit was only 1% of BYD's, and BYD has now surpassed SAIC in sales volume. This loss of the top spot in China's auto market adds even more pressure. On October 10th, SAIC's September report showed sales of 313,300 new cars, a 35% decline year-on-year. SAIC GM, one of its joint ventures, saw sales fall by 78% to just a bit over 22,000 units in September. This marks the third month in a row that SAIC has seen sales declines of over 35% after similar drops in July and August. The first quarter of this year hinted at a growing crisis, with SAIC's net profit reaching 2.7 billion yuan, down 2.5% year-on-year. By the first half of the year, revenue had fallen by 12.8%, and net profit was down by 6.5%. SAIC GM reported a net loss of 2.3 billion yuan, which wiped out the profits from other subsidiaries like SAIC Volkswagen and SAIC GM Wuling. Analysts say that both state-owned and multinational car makers are struggling. They face fierce price wars in the fuel vehicle market, dragging profits down. As fuel cars struggle to sell, traditional automakers continue to suffer. For over a decade, until 2023, SAIC led China's auto market in sales. But since the US-China trade war began to escalate in 2018, followed by the COVID-19 outbreak in 2020, SAIC's performance has steadily declined. From 2019 to 2023, SAIC's revenue dropped each year, with figures ranging from 843 billion yuan in 2019 to 745 billion yuan in 2023. SAIC's sales have also declined annually. In 2023, the company sold just 5 million vehicles. In the first 9 months of 2024, sales reached 2.7 million, a 21.6% year-on-year drop. All subsidiaries except IM Motors saw declining sales, with SAIC GM being the hardest hit. Its sales dropped from 720,000 units last year to 278,500 units this year, a 61.6% decline. In 2023, SAIC's exports and overseas sales totaled 1.2 million vehicles, with Europe as its largest foreign market. However, the company faced the EU's recent anti-subsidy investigation, receiving the highest tariff rate of up to 35%. Since these temporary tariffs started in July, SAIC's export volumes has dropped by double digits for 3 straight months. As a result, its overseas sales declined by 11.8% year-on-year in the first 9 months of this year. With sales continuing to slide, SAIC's 18-year streak as China's top automaker is now at risk. China's broader economic environment is worsening, and the auto market faces an oversupply problem. Fuel vehicle sales are falling sharply, which only adds to SAIC's troubles. SAIC Motor's current struggles led to a bold statement from the company's new president, Jia Jianxu: "We must learn to bow down." In a speech that was leaked from SAIC's mid-2024 executive meeting, Jia made headlines with his surprising remark, telling executives that SAIC's leaders must learn to bow down. While Jia's bow down comment was intended for internal discussion, it has since leaked, revealing the tough position SAIC Motor finds itself in. SAIC's declining performance is part of a broader trend. The entire Chinese auto industry is stuck in a sell more, lose more cycle as price wars continue to cut profit margins. According to the China Passenger Car Association, the industry's profit margin dropped from 6% in 2020 to 5% in 2023, despite record-breaking sales each year. From 2020 to 2023, domestic auto sales increased from 25.3 million to 30.1 million units. Why is profitability dropping even as sales grow? Analysts say low demand in the domestic market is a key factor. Fierce competition in a limited market has led to intense price wars. China's electric vehicle companies are also facing long-term losses. On October 31st, Bike Blue Park, a subsidiary of Bike Group focused on electric vehicles, reported a net loss of 4.5 billion yuan for the first 3 quarters of 2024, a 38% increase from the previous year. The company attributed this to a worsening price war in the EV sector. NIO also suffered losses in the first half of the year, with a net loss of 10.4 billion yuan, up almost 5% year-on-year. Total cars sold was only 87,000. This translates to an average loss of 118,800 yuan per car sold. Since its IPO in 2018, NIO has accumulated over 97 billion yuan in losses. XPeng Motors reported a net loss of 2.65 billion yuan in the first half of the year. With sales of 50,000 units, this translates to a loss of about 50,000 yuan per vehicle. XPeng's financial report openly states that the company has operated at a loss since its founding. By June 30th, 2024, total losses had reached 38.4 billion yuan, including a 2.65 billion yuan loss in the second half of 2023. Geely's premium brand Zeekr sold 87,900 units in the first half of the year, but also faced losses, with a per-vehicle loss of 43,600 yuan. Similarly, Leap Motor sold 86,700 units and posted a per-car loss of 25,500 yuan. Professor Kuo Qiang-sun from Nanhua University in Taiwan explains that overcapacity in China's electric vehicle industry is a major factor driving these losses. He points out that excess supply has led to intense competition, especially in the mid to low-end market. Car companies are forced to lower prices to attract buyers, squeezing profits even further. Many firms have also ramped up investments due to shifting policies and shrinking subsidies, which has increased costs and left inventories unsold, deepening losses. Overcapacity, he says, is a critical issue affecting the industry's profitability. China's overcapacity in the EV sector has been a topic of concern internationally. In April, both U.S. Treasury Secretary Janet Yellen and German Chancellor Olaf Scholz raised this issue during their visits to China, citing risks from China's macroeconomic imbalances, including low consumer spending and excessive corporate investment. In April, the National Development and Reform Commission attributed falling vehicle prices to oversupply and declining battery costs. The commission noted that China's new energy vehicle production reached 9.4 million units in 2023, up 30% year-on-year. Planned deliveries from companies like BYD, Huawei's Aito, and Li Auto alone are expected to add 2.3 million units in 2024. Yet market demand is only forecast to increase by 2.1 million units, keeping the market oversupplied. According to the MIT Technology Review, in its bid to dominate the global EV market, the Chinese government has invested around $230 billion in subsidies, tax cuts, procurement contracts, and other incentives. This has built a market of 13 million vehicles, or 60% of the world's EV fleet. The Center for Strategic and International Studies reports that from 2009 to 2023, China spent over $231 billion on EV subsidies. Funding doubled from 2018 to 2020 and then rose sharply again from 2021 onward. The Chinese government provides funding for its electric vehicle sector in 5 main ways. These include state-approved buyer rebates, a 10% sales tax exemption, infrastructure support, mainly for charging stations, R&D programs for EV manufacturers, and government EV procurement. This massive level of support reflects how the government views EVs as a strategic sector with global market potential. However, these policies have led to overcapacity, pushing some global automakers to restructure or even exit the Chinese market. In October, Mitsubishi announced it would stop manufacturing cars in its Chinese joint venture. Other companies, including Honda, Hyundai, and Ford, have reduced costs through layoffs and plant sales. GAC Mitsubishi's exit from the Chinese market is also expected. From the point of view of sales, GAC Mitsubishi has made certain achievements in the era of fuel vehicles, but in recent years, its momentum has gradually declined to the trough. In 2018, GAC Mitsubishi's sales reached 114,000 units for the whole year, a year-on-year increase of 23%, far exceeding the overall market growth rate of that year. At that time, its main sales model, Outlander, was favored by consumers, and its sales for that year were as high as 105,600 units, almost equivalent to the entire brand's annual sales. But from 2019 onwards, GAC Mitsubishi sales have continued to decline. To 2022, their sales slipped to only 33,600 units. In the first half of last year, cumulative sales were 12,000 units. At the same time as sales continue to fall, GAC Mitsubishi's financial situation is not optimistic. GAC Group announcement disclosed that as of March 31, 2023, GAC Mitsubishi audited total assets of 4.198 billion yuan, total liabilities of 5.613 billion yuan, net assets of minus 1.414 billion yuan, and has fallen into insolvency. According to Hong Chen, a senior scholar at the Atlantic Council's Geoeconomics Center, overcapacity is a common issue within China's state-led economic system. The CCP directs large investments into specific industries, and without market-based constraints, this often leads to overproduction and its negative side effects. Governments worldwide are now responding to China's EV practices. After a year-long anti-subsidy investigation, the EU officially announced on October 29th that it would raise tariffs on imported Chinese electric vehicles. These new tariffs took effect on October 31st. Under the EU's plan, additional tariffs will apply to China-made EVs, ranging from 7.8% to 35.3%, on top of the standard 10% import duty. The EU imposed specific tariffs on major Chinese manufacturers, 17% for BYD, 18.8% for Geely, and 35.3% for state-owned SAIC. Geely owns brands like Polestar and Volvo, while SAIC owns MG, one of Europe's top-selling EV brands. As a result, these new EU tariffs hit SAIC's MG the hardest. These extra tariffs also apply to foreign-made EVs produced in China, such as Tesla, which now faces a 7.8% duty. Other car makers in China, like Volkswagen and BMW, will pay a 20.7% tariff. European Commission President Ursula von der Leyen first proposed an anti-subsidy investigation into Chinese EVs in September last year, officially launching it the following October. By rule, any investigation must finish within 13 months. After a thorough investigation, the EU found that Chinese EV manufacturers benefit from heavy government support. This support allows them to undercut EU competitors and take significant market share, which the EU says threatens European jobs. The European Commission noted that Chinese-made EVs now make up 25% of Europe's EV market, up from just 3.9% in 2020. The Commission claims much of this growth is due to unfair pricing below EU market levels. According to the Commission, China has gained EU market share by subsidizing the entire production chain. These subsidies include cheap land for factories from local governments, low-cost lithium and battery supplies from state-owned companies, and tax breaks and easy financing from state banks. Using these tactics, the CCP has captured market share in Europe, which puts 2.5 million European auto jobs at risk. This shift also impacts the livelihoods of an additional 10.3 million people indirectly tied to the industry. EU Trade Commissioner Valdis Dombrovskis said, "By adopting these proportionate and targeted measures after a rigorous investigation, we're standing up for fair market practices and for the European industrial base." He added, "We welcome competition, including in the EV sector, but it must be on fair grounds." France's Finance Minister Antoine Armand said that at a critical time for the auto industry, the EU has made a decisive choice to defend our trade interests. Reuters reports that Italy and France have been encouraging Chinese automaker investments, but have also warned that cheap Chinese EVs could harm European manufacturers. Renault's CEO Luca De Meo noted that the EU's tariffs are based on World Trade Organization rules, which all member countries, including China, have agreed to. In October, Canada also imposed a 100% tariff on Chinese-made EVs. In July, Brazil raised its import tax on pure EVs from 10% to 18%, with plans to increase it to 35% by July 2026. That same month, Turkey added a 40% extra tariff on Chinese EVs. In May, US President Joe Biden announced that tariffs on Chinese EVs would triple, increasing from 25% to 100%. China's global EV sales have now appeared to be trending downward. Recent data shows that the number of EVs registered by Chinese automakers in Europe has been declining since July. Bloomberg reports that, according to Dataforce, fewer than 14,000 Chinese EVs were registered in Europe in July, down from more than 23,000 in June, marking a 9.7% drop from July 2023. Analysts believe these global countermeasures have dashed hopes for Chinese EV makers to increase sales in the short term. Some Chinese automakers are now considering building factories in Europe to avoid these tariffs. BYD is constructing a plant in Hungary, while Chery is producing cars in Spain through a joint venture. Assistant researcher Wang Guochen at Taiwan's Mainland China Economic Research Institute says China's EV price advantage comes from government subsidies. However, he adds that the CCP no longer has the fiscal resources it did a decade ago to maintain such high subsidies. Without these subsidies, Chinese EVs would struggle to sell abroad. He also notes that EVs may eventually evolve into mobile offices with cameras and recording devices, which raises concerns about data protection and digital surveillance. This, he says, could further complicate future sales to Europe.